Welcome to the Real Estate Reserve Podcast with your hosts, Jason Balin and Ian Horowitz.
Zillow, what are you doing? What are you doing? Jason's over here waving like you guys did something right. What'd you guys do? Let's read a couple quick headlines. Jason unfortunately relinquished the microphone to me, and I get to do today's open, but I'm jumping right into it because this is insane. Zillow quits home flipping business. Zillow, which released earnings Tuesday, said its home flipping business, Zillow Offers, lost $381 million last quarter. Zillow to stop flipping homes for good, as it stands to lose a ton of money. What are you guys doing? We're going to jump into this, and we're going to go over what we think potentially happened and why they can't be profitable in this space, even though everyone thinks it is so easy to do. I'm Ian Horowitz with Equity Warehouse, and my co-host
Jason Balin with Hard Money Bankers.
So yeah, man. So let's Jason, let's jump right into it. I know I was texting you late last night. Everyone was popping up articles about this, and I feel like a lot of people are caught off guard by this, which I've actually found I'm more caught off guard that people are caught off guard by this exact topic, because I feel like me and you have discussed this at length of why running a national flipping business or a tech company that thinks they have all the information can handle this.
Well, let's say this first. Tech doesn't replace humans, and I don't believe it ever will, especially with an offline business like real estate. Real estate's an offline business. I know companies, individuals, folks want to state that you can automate, digitalize, do whatever you can to make this an online type of business. And there's obviously tools and resources and software to do so, but you still have that online offline blend. It's still a physical piece of real estate. It's hard to completely replace a human and just completely do this as tech. So that's one thing, in my opinion, is tech's never going to replace humans for real estate. There's a lot of things that real estate is over the last, just since COVID hit, right? A lot of things we can all do digitally, including, digital closings, digital notaries, things like that, stuff that, should have happened decades ago that never did, right? So there's definitely a space for tech in this, but it's not going to just replace it's not just going to replace everything. So like there's a few bullets related to this topic. I know you have some and I have some, but like that was the first one. And I think the localization of real estate, at least in the single family world, I've always thought has been very, very difficult to do. I mean, I'm not talking about larger commercial projects and self-storage and stuff like that and multifamily. That's different. But these one-off $100,000, $200,000, $300,000 single family houses, I've always believed that's hard to do if you're not local, if you're trying to do it national, and most importantly, if you're trying to do it at scale. Anyone can do it on a small scale, but as soon as you try to do it on scale, it's a completely different game.
Yeah, I think we should talk about the tech piece first, because I think that's where everyone's head is, especially in today's age, because I think the tech piece relates back to exactly what you're talking about and being hyper local. So Zillow's office is in Seattle, Washington, I believe, right? And you got a bunch of people sitting there behind a computer just plugging away at numbers. I don't have any pro formas in front of me, just sitting there plugging away at numbers and going, this seems like a deal. It works in my market. It's got to work here, right? They're just looking at pro forma numbers. There's no relationship between them, the marketplace, the quick condition. What does the market dictate? Why is there so much inventory in that place? Yes, maybe they're taking account into those factors, but your pro forma doesn't have any emotion tied to it, right? And I think that's one of the problems that potentially that they run into. Here's a company that has a ton of capital. They're looking to deploy it. They're trying to get a return for their investors at market, right? And they're trying to hit all these metrics, but yet you got a pro forma. That doesn't necessarily mean that it's a good deal. And I've talked to some companies. I know at one point we had a private equity firm and a publicly traded company looking to come to Baltimore. And they said, look, we need 300 houses to operate here. Can you deliver us 300 houses? And I said, well, the market doesn't dictate that. We don't have that kind of inventory, right? And these guys just look at it as it's just a number. It's just a number. They're just trying to deploy billions of dollars, and it just doesn't make sense, you know. So
So let's break down a little bit of why some of this stuff doesn't necessarily make sense in general. And I know that's hard for a lot of folks to maybe think, you know, especially if they come from a bigger industry, if they're used to doing a larger multifamily project. But in my opinion, there's three aspects of a single family real estate project. Could be a rental, could be a flip. In Zillow's end, these were all flips, right? All of that they were doing with flip. Is it even freaking harder, right? If these were rental properties, it might be a little bit different, but flips, God, that's hard. It's so localized. So typically you have 1/3 is capital, right? 33% of the transaction is capital. Zillow's got plenty of capital, right? So 1/3 of this they're good on, and they'll be forever, right? They got plenty of or companies like that will have capital. The next third is having a good deal. Now they might think they have a good deal, right? Because they control a lot of tech, they control, online and digital deal flow, and I get it. I'm not going to agree that those were good deals, but like they have the ability to potentially originate deals. And then obviously the last third is an operator, you know, boots on the ground, someone that kind of has resources, can do construction, you know, things like that. Like those are typically the three most important things of a real estate transaction. And as far as I'm concerned, the only thing they brought to the table was capital and potentially deal flow. Not saying good deal flow. Like I don't care who you are. It's hard for me if you're listening to this and you're living, you know, on one coast and you want to go invest on another coast. If you're living on the East Coast, you want to invest on the West Coast. I don't know how you're going to do it. I really don't. You know, I'm not saying you can't go find a good deal out there, but you're going to find dozens or hundreds or thousands of deals spread across. You just don't have the market knowledge.
Well, yeah, that's 100% it, right? Like when I look at it, I think we could all go online right now and go and look at a deal and say, hey man, I think this deal looks badass in Missouri, or I don't know, wherever. Let's just say Missouri. We look at something in St. Louis and like, oh, that seems like a great deal. I know here we could trade it for this. But we don't know the intimate market data of the school systems, of what the taxes are, why people are moving there. Yes, you can research all this, but can you really research all that? Or can you spend better time in your local market flipping houses if that's truly what you want to do, and have all the resources close to you, or operate in an area that you have very intimate knowledge with, right? Like we grew up outside of Philadelphia and we haven't flipped many houses up there because the market, like, even though we're from there, I don't know the real estate market per se. And I think that's where a lot of this gets jammed up, of them trying to force the hand of what the data was telling them and saying, well, we got the money, we can endure this pain even if we're wrong. And think about it, they're losing $381 million in probably one of the most rising markets we've seen since 2008, right? Like the market is absolutely out of control. There's no inventory out there. Nobody's doing anything. And these guys lost $381 million trying to flip houses.
And it doesn't surprise me at all. It doesn't surprise me at all, because if you F up as an operator, you F up. That's what it is. I'm there. I mean, I already, you know, I don't know one property they purchased, and I don't need to know one property they purchased. I know exactly what they did wrong. Number one, they bought too high. Their construction costs went over budget. They probably had a hard time with operations and dealing with contractors. Whatever it is, right? They either over improved, they under improved. They didn't know the market conditions. They didn't know what they could do. They related it to some algorithm or some, you know, model that they put at corporate and says, let's do this. And that differs in every market that around the country. It differs all the time. I mean, how many real estate investors do you know that have tried to get into other markets because they felt that the DC area, the Baltimore area, the Philadelphia market was overinflated, or was just too expensive, right? And they wanted to go to, you know, maybe a smaller area and buy cash flow properties, or a bigger area that there was still more spread. And again, this isn't about us individually on a one-off basis. We could all go buy a property on a one-off basis, but after you scale, on a, it's a very different game. It's not just like, hey, I'm up here, I'm gonna go throw a lot of money at this thing, and we're in a good spot. Let's make it work.
Yeah, I want to get into the next piece of this topic, but I'll give you a real life example. When we bought our apartment buildings in West Virginia, we came from Baltimore, where we're doing granite, stainless steel. And again, this is a rental property, but we still had to go in there and improve these properties, right? We're used to putting in stainless steel. We're used to putting in granite. We're used to putting in central air conditioning, all these different amenities. We get out there and we look at these apartment buildings and we're going, man, there's window AC units. There's laminate countertops. Like, there's no amenities here. And our property manager's like, we don't need them. We're in West Virginia, but we're also in West Virginia. We don't need these amenities to get this rent. And I had trouble digesting that. And that's the same thing. People's taste or people's amenities required in Seattle, Washington are way different than what's required in Miami. So I think that's something that you need to understand when you're going into it, whether it is a flip and or a rental. Let's say you are in DC and you're buying stuff in the Midwest or elsewhere throughout the country as a rental property. Make sure you're status quo with what the market is dictating. I'm not saying being, if the market's cheap, you be cheap, but, still have pride of ownership, but you definitely want to meet what the market's standards are and not over improve and operate at the most efficient way you can. And I think that goes into the next piece of this. It's really hard to do one flip, let alone thousands of flips. We were out of our mind. We were doing 30 flips a year. We always had something going on. And yes, there's an advantage to when you have the machine and keep the guys rolling and doing all these other things. But man, it is hard. And Jason, you see a lot more deals that come across your table of guys that are operating with multiple deals at a time. I mean, what do you see from those guys?
Yeah, and I'm glad you brought that up, Ian, because that actually was one of my first bullet point when I was thinking through this topic related to how hard flipping real estate is. It's hard. There's so many elements in in it. Can anybody do it? Yeah. But it's hard work. You're not just throwing money or resources or time. You have to be the one that's doing the heavy lifting and understand it. And, obviously we're in a market right now that if you bought a property at a halfway decent price, the market for the most part saved you. And as beneficial as that could be, it also could be your biggest curse because you think you have it all figured out and you're going to get punched in the teeth when the market shifts. It's just that simple, right? You bought, think about the old school ways of buying a property. You buy it at 65 cents on the dollar minus construction costs, right? It's very, 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 very simple. You can push that to 70 and it makes sense. You can't push that to 72 or 74 cents on the dollar minus construction costs. That doesn't work. It just doesn't. I don't have to do the math for you here. Do the math yourself, and you'll see that formula does not work. Now, where it could potentially work is if, let's just keep the numbers very, very simple. You think the after repair value is $100,000 today, and it goes up to $110,000 by the time you sell it, or you sell it for $110,000. Hey, you look like a hero, right? You bought it. It worked, but that's what's happened over the last few years. And I read part of this article, and part of the press related to Zillow was they're stating that Zillow failed in predicting home prices. This has nothing to do with, in my opinion, nothing to do with predicting home prices. Were they predicting that they were continue to rise and rise and rise, and they could just be foolish? But
that's even more scary. That's even more scary if they couldn't predict the prices. If they didn't predict the prices are above probably what they already predicted, unless they had such an insane outlook on what the market was going to be.
But no real estate investor is predicting the value. No. You're not going into a property stating, hey, the value, the street value is going to be 100, but I'm going to sell this for 110 because the market's going to appreciate. It doesn't work like that.
Well, let's do it this way. Let's do it. Let's think about it like this. I do a house. I buy it at whatever. I buy it and I think it's worth $100,000 and I expect to make 20 on it. And then I wind up selling it for 120. The next deal that I do in that exact marketplace, should I underwrite it again at $120, or should I underwrite it at 105 or back to 100 where I originally thought it was? Because that might have been a one-time thing. I think we're both trying to say the same thing here of just because your predictions potentially are right, it doesn't mean that you should go and keep pushing your numbers and say, well, it's going to work. It's going to work. It's going to work. It's going to work. Same thing with whether it's a flip, a rental, or anything. Just because you're getting $1,500 on one house doesn't mean you're always going to get $1,500 or better. You could still wind up with that $1,300 house because it doesn't rent as well. You got to drop the rates. Here's the question. Do you always want to be at the top because you have to be at the top, or do you want the ability to be able to race to the bottom and have way more runway than everybody else in the marketplace and still make money and save your ass, right?
Well, I mean, here's another thing. You're not scaling. There's no way to do the amount of volume that they were probably predicting to do, or anybody wants to do at scale in a market today. There's just no way to do it. Like, the numbers just don't work. Like, you're putting resource, it's not like, oh, we have cheaper capital than everybody else. Okay, well, that's one small element of all of this. Think about it. Think about how many deals, and don't get me wrong, there's still a lot of opportunity out there, right? There's still deal flow out there, but that doesn't necessarily mean that, like, there's thousands and thousands that one operator could potentially go after. Like, if you wanted to go in any market we're in, like in Baltimore, and you wanted to go pound pavement, hit the streets, go get under market value deals, you could do it. You could be like, yo, I need to buy 3 properties or 5 properties, maybe 10 properties a month. And by doing proper marketing campaigns, you could do it. There's enough deals out there to do that. But, that's if you're a localized investor with, putting the heavy lifting in, creating a marketing machine, doing it that way. You can't just go on MLS and be like, oh, cool, I'm going to go buy, these 100 distressed properties on MLS at the market rate. The number is not going to work on that. But real quick, back to the predicting home prices. Like, I mean, it seemed to me that, what I read up on related to Zillow predicting home prices is that they were thinking that the market was going to continue to increase and basing their model off that, which, if that's the case, completely foolish, because no real estate investor, if they think the property is worth $100,000 today, they're not hedging that it's going to be worth $110,000 tomorrow. That's the worst model ever. There's no appreciation in flipping. Appreciation is a bonus, right? You buy a rental property, you buy a long-term asset, and if it appreciates, great. But you're never, ever, ever basing your business model on appreciation. If anything, you're basing it on depreciation. That, hey, I bought a property today at 100, that's worth $100,000. There's a chance it could only be worth 90 tomorrow. I'm going to base my numbers off that. And if it's worth, 100 or 105, that's all a bonus.
Well, call the CEO up, tell him to call me, because I think he potentially was onto something. And I've seen, I'll take some good out of this, is that, like anybody else, they suck at flipping houses, and it's a real pain in the butt, and nobody wants to do that, and it doesn't create long-term wealth. They were trying to get a cash grab, right? But I would tell the CEO the same thing. If you're willing to place your money and you have the ability to endure the pain and wait, that even if you're paying a little bit above market, you guys could have rented these houses out, and they probably got super cheap cost of capital, that they could have endured the pain and waited till rent caught up to their performer, to their prices that they were into these houses for, actually been in a really better position, and then sold these off at a later date. Basically, kind of like a covered land play a little bit. You go in, buy them, rent them for a period of time, and then turn around and sell them because they've increased in value. I think that would have been the better play for them. Like I said, when one of the companies that came through Baltimore was actually Amherst. On average, they'll do 3,000 houses at a time, all through the Midwest, and they're buying them, making them into rentals, and then selling them to pension funds. And this was before Blackstone, BlackRock, Black everything got into this space. They've been doing this at scale for a long period of time and have been uber successful at it. Their cost of capital when we were all paying 5% was 1.5%, and they're getting leverage at 90% on $1 billion. So their spread on that 10% is insane. And it's a totally different thesis. So yes, Zillow, you guys were onto something, looking at house values and having all the data in front of you and all the deal flow and the capital to you. I just think they should have taken a different business plan of potentially flipping the ones that they could make really good money on and retaining the ones that weren't going to be great deals, and turning them into rental properties and holding them and packaging them up at scale.
Yeah. Yeah. I mean, is this the first company that you know of at that size who gone down this path? I know there's lots of companies that have done stuff on the rental side, but this path, and don't get me wrong, I know there's companies that do this at, hundreds at a time.
Well, there was a guy local to Virginia that did it. at scale. But still, these guys endure a lot of pain. But again, he was in Virginia, operating in the DC metro market that encompassed Maryland, Virginia, West Virginia, and he wasn't really getting outside of our area. He still had intimate knowledge, even though it was 3 or 4 states. Still intimate knowledge of the area. Plus, you have all the resources. That other company that I just mentioned, Amherst. At one point, they were flipping houses, but I think they got out of the space because they said, well, we could just make them rentals. We retain the management and we sell them to pension funds who are paying insane cap rates. And this was pre-COVID when a 6 cap was an insane cap rate. I can only imagine what they're selling them at now.
Yeah, I mean, their costs are higher though now too. Between cost to purchase it, cost of renovations, all of that stuff. I mean, the numbers just don't work at a high scale. Anybody can do anything on a small scale. And keep in mind, like when we say big scale, I mean, this isn't like, hey, I'm a real estate investor and I flip 50 houses a year. Like that might be a big scale to like most of your peers and colleagues and people that all come to meetup groups together. But like,
their problems problems are in relation to the guy that's doing one deal.
And also you also know that your costs won't necessarily go down. There's only so much your costs are going to go down as you're doing this stuff in scale. It's the stuff just doesn't scale together. I mean, I've seen it in so many different types of business ventures.
Yeah, definitely. I'm not sure if we have any questions in the comments that are worth going through, but it's an interesting topic, and I think we'll continue the conversation inside of each of the threads wherever you're watching this. And I think this is something that's going to evolve over a period of time, and I think it's going to push back on the guys that are solely relying on tech. And I think we've talked about in some past episodes where we talked about, what softwares you use. The software is only as good as the input that's going into it, in exchange of you can't solely rely on that piece of software. It's a tool.
I don't know, man. I don't want to relate this to like hard money lending because we only lend locally because it's only in areas that we know, and we utilize all of our own funds. And I can't, could I write a good loan in Midwest somewhere? Sure. I could go find a good loan and write it. But like, do I want to create an entire operation? Do I want to, scale it? Like what do the numbers look like? It just doesn't work. Like, and it's not just when it's good, it's also when it's bad. Like, these guys, I mean, Zillow already shit the bed and stuff's still selling, right? Imagine what happens when stuff completely stops and all of a sudden, no homeowners can get, conventional financing.
Yeah. And look at your, let's relate it to hard money lending. Let's do it real quick. Your biggest competitors, I don't want to name them out there. Most people already know who they are. Your national competitors,
institutional back lenders.
Yeah, they had the same trouble. They come in the market, they get beat up, then they either sell them to another REIT or whoever else, or they go out of business. It's one of the two, and then they just change their rates, and they can't do it at scale. It's a hard.
What they do is it's a race to the bottom in that business, right?
The capital is so cheap for them, right?
But still, it's a race to the bottom. It's like, cool, we don't have enough deal flow. I mean, number one, just so people know, like big businesses, big companies that have a lot of back capital, they don't get into a space unless they can deploy hundreds of millions or billions of dollars. It just doesn't work. So, I mean, they're playing the skinny margin game. So what ends up happening is it's like, cool, this institutional back lender wants to be at whatever, 999. That's how the business model's set up. And it's like, wait a sec, now we got to go to 949 or 899 or 699 or 599, whatever the case is. And their margins, their cost of capital, might end up being a little bit cheaper, but their margins are going lower and lower and lower. And guess what happens? As you're making less money. You're making less money, but you're making it on a high scale. But what happens when you scale up? You have more employees, right? You have more overhead. You have more risk. There's a lot of stuff that works, right?
Right. And the way you're explaining it, I would say, well, if I'm getting 599 on a hard money loan, that's super risky, right? Like there's a ton of risk involved in that, and having to deploy the money that's behind it, making sure that people are doing what they say they're going to do. At 599, I might as well take a little less money and just do just lend money out on commercial real estate for long-term money or homeowner type stuff, and just like, why take the risk for those skinny margins? If you're going to do that, swap it out.
But it's the same thing as a real estate investor, right? Let's say a real estate investor, they flip a deal and they have some money. They're ready to flip their next deal. And they say, okay, well, I want to buy this property at 100 grand and needs 50 grand of work. And I can sell it at 200 or whatever. Right. And then they come in and they say, well, I can't get it unless I can buy it at 110. I'm not going to make as much as I want, but I really need to do a deal. Right. And it's the same thing. And I'm like, cool, then I'll do that. But then all of a sudden, when you get caught with your pants down, is all of a sudden, okay, well, you also were a little bit too emotional on what you thought these construction costs are going to be. And then your construction costs go up, or this goes up, whatever the case is. And next thing you know, you're making, less and less and less, hopefully no money. Hopefully you're not losing money. But like, that's what happens. I see too many real estate investors flipping houses that aren't making any money, or losing money. And it's not just like going into these, like, how are you going to make money? Like, the margins are so slim. And then their emotional excuses, well, that was the only deal that I could get. And it's right. Like, you either can't do that, can't do the deal, or your ass better go, start marketing on the front end to find good opportunities. So again, Zillow doesn't know if these are good deals. Their algorithm told them that they're good deals. Their metrics, their data points told them they were good deals. Like, as far as I'm concerned, there's no data point that would ever, there's no software or data that's ever going to tell me a property that I lent on is a good deal. That's me. Right. Am I going to use that data as resources and talk to other people and use my past knowledge to come up with that? But I'm not going to just rely on this data of like, oh, hey, we have this. It says that the property as is value is 100, or after repair value is 200. You're not going to do that. You're not going to do that either. You're not going to be like, oh, hey, my machine told me that this deal's good. There's a human element to this. I don't care. Anyone can challenge me on that part. There's a human element on it. Yep. And I'm not stating that's the case on all types of asset classes. Some of the bigger asset classes, it's a little bit different. But for this type of stuff, single family stuff, the stuff that Zillow failed in, that's the issue.
Yeah. And speaking of which, speaking of algorithms, I think everybody should help us out, beat the Facebook, Instagram, and every other algorithm out there. If you got value out of this show, please share it. We don't advertise this show at all. So if you want to help us beat the algorithm and actually, grow this show and help us out, we would appreciate it, because we just try to bring value. I was probably going to pick up the phone, call Jason anyway and say, hey, did you see that? Actually, I did. I said, did you see what happened to Zillow? And we started talking about it. I was like, good, let's do a show tomorrow morning about it. So me and Jason, this is us talking about it in real time. And this is why we do this show. So please, if you got value out of it, go ahead and share it. So
exactly. And the good news is, for all of us real estate investors that are local, we're grinding, we're working hard, we understand and respect kind of the resources that we all individually have. And, we know we don't need to go buy hundreds and thousands of properties. We want to do a small amount responsibly with very little risk and make as much profit as possible. It's good to know that just because you have tons and tons of capital doesn't mean that you can succeed any better than any one of us. It's good to know that the signs of this real estate market aren't just like, you can't just list any property at any fake price and sell it, right? The market's not going to continue to go up and up and up and up. And that's a good thing. That's not a bad thing. I don't think it's a benefit to anybody for the market to really, really crash, but like, it's good to kind of stay, in a good spot. So, it's not like we're not trying to hate on Zillow, but I do think that we're probably hate on how realistic they were on what they were trying to accomplish in this space. And it just goes to show that, they're not your competition. There's lots of good opportunities out there.
100%. Well, that being said, I got a billion and one things to do because we're closing out a super big deal on Friday. People are trying to give me money, so I got to go.
All right, man. Do your thing. Well, I'm glad we had this conversation, because if not, we would have just done it off camera on speakerphone in individual offices. So now I felt like we did this together between the two of us and our community that we really appreciate. We really appreciate you guys tuning in, following us. Again, if you got any benefit from this, you want to share this with, a colleague, a friend, a business partner, or another real estate investor or agent in your office, please do so. You can always check us out at reservepodcast.com. Follow us on iTunes, on our YouTube channel, and things like that. And we'll be back next week with another fun show. Take care.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm